Ever wondered how businesses fund their operations and growth? Well, strap in because we're about to embark on a financial journey. Business finance, the lifeblood of any enterprise, is a fascinating realm. It's the engine that powers the machine, the wind beneath the wings of innovation and growth. Now, imagine a business as a car. Without fuel, it simply won't go anywhere. That fuel, ladies and gentlemen, is finance. There's a broad spectrum of financing options available to businesses, from traditional routes like bank loans and personal savings to more modern avenues such as crowdfunding and venture capital. Each option has its own merits and considerations, and the choice often depends on the business's stage, goals, and industry, among other factors. Understanding the landscape of business finance is not just a matter of academic interest. It can be the deciding factor between success and failure, between expansion and stagnation. So without further ado, let's dive into the top 10 sources of business finance. Starting at number 10, we have crowdfunding. Picture this, a virtual stage where you present your business idea to the world, hoping to attract a crowd of investors, big and small. That's crowdfunding in a nutshell. It's a powerful tool that can turn dreams into reality. But it's not without its challenges. It requires a compelling pitch and a solid marketing strategy. Yet, despite these hurdles, crowdfunding is a great way to raise funds, especially for startups. At number 9, we have venture capital. This refers to financing that investors provide to startups and small businesses that are believed to have long-term growth potential. Unlike other sources, venture capital involves a trade-off, typically equity in your business. Pros: significant funding and valuable guidance. Cons: you might lose some control over your business decisions. This isn't for everyone, but for businesses with high growth potential, it can be a game changer. Venture capital is a substantial source of funding for businesses with high growth potential. Coming in at number 8 are angel investors. These are high net worth individuals who provide financial backing for small startups or entrepreneurs, often in exchange for ownership equity. They're called angels for a reason. They might be your saving grace when other funding options fall through. However, it's important to remember that they usually seek some level of control in your business. The upside? Angel investors can provide not just funds but also invaluable advice and connections. At number 7, we have business loans. These are simply borrowings that companies undertake, typically from banks, to support their various business activities. They offer the allure of larger capital reserves, allowing businesses to expand and grow. However, they come with their own set of drawbacks, including interest payments and the requirement of collateral. Yet, despite these challenges, business loans continue to be a go-to source of funding for many established businesses. Number 6 on our list are personal savings. Ah, yes, the classic piggy bank approach. Personal savings can be a reliable source for business funding. It's your money, so you call the shots, no strings attached. However, it isn't all sunshine and rainbows. Using personal savings can put your financial security on the line. If the business stumbles, you might find your nest egg cracked. So, while personal savings provide the most freedom, they can also expose you to personal financial risk. Halfway through our list at number 5 is trade credit. This is a financial agreement where a supplier allows a business to purchase goods or services on account, with payment to be made at a later date. It's a great way to manage cash flow, but beware, late payments can harm relationships with suppliers. Trade credit is like a double-edged sword. It can boost your business when used responsibly, but misuse can lead to financial strain. Trade credit can help businesses manage their cash flow effectively. Coming in at number 4 are grants. These are non-repayable funds provided by governmental bodies, foundations, or corporations, typically given to specific projects or causes. To obtain a grant, one needs to apply and meet the grant's specific criteria. The pros? Well, they're non-repayable, making them an attractive option. The cons? They can be highly competitive and time-consuming to secure. But let's not forget, grants are a great source of funding as they don't need to be repaid. At number 3, we have retained profits. Now, these are the earnings a company holds onto, rather than dishing out as dividends. They can be reinvested back into the business for expansion, research, or even to pay off debt. The beauty of this financing source is that it's cost-free and doesn't dilute ownership. However, it does rely heavily on the business's profitability. So it's a bit of a balancing act. In essence, retained profits are a direct result of a business's success. Just missing the top spot at number 2 is leasing. Leasing is an arrangement where a business rents an asset from a lessor for a specific period, rather than purchasing it outright. This method can be advantageous for business owners because it allows them to utilize expensive equipment or premises without a substantial upfront investment. However, on the flip side, you may end up paying more in the long run. Despite this, leasing can be a cost-effective way to access expensive equipment or premises. And finally, at number 1, we have equity financing. This financial strategy involves selling a portion of your business's ownership or equity to investors in exchange for capital. It's like inviting others to share not just the profits, but also the risks of your business venture. Now, how does it work? Well, investors purchase shares of the company, and in return, they provide the funds that the business needs. They become part owners and usually have a say in business decisions. But what are the upsides and downsides? The biggest advantage is that you don't have to repay the funds like a loan. Also, these investors often bring expertise and connections that can help grow the business. On the flip side, you give up some control over your business, and future profits are shared with investors. Equity financing can provide a significant amount of funding and shared risk, but comes at the cost of ownership. So consider carefully before you decide to go down this road. So, there you have it, the top 10 sources of business finance. We've journeyed together through the diverse landscape of funding options, from crowdfunding and venture capital to angel investors and business loans. We discussed the merits of personal savings, trade credit, grants, retained profits, leasing, and finally, equity financing. Each of these sources has its unique advantages and potential challenges. Remember, the right source of finance depends on your business's specific needs and circumstances. Always weigh the pros and cons before making a decision.